macro, regulation, and market structure will mean for crypto and for Solana. No hype, no shilling. Pure signals straight from the experts. This is the big picture.
Ladies and gentlemen, welcome back to The Big Picture. Season 2 is officially live, and my goodness, what a time to be back. We've had a brutal first half of the year. We had hacks, exploits, 10 months of down-only price action, and basically every other asset class in the world enjoyed massive returns. So it seems finally that the crypto winter is somewhat sawing, but it remains to be seen where we go from here. It is now August 27th, and here's what we're looking at today. Bitcoin is back above $80,000. Sol reclaimed $100 and even touched $105 today. Zcash, of course, has torn through its 8-year high north of $860, has somewhat cooled off, but the privacy trade continues to roar. And of course, we can't forget Hype as well, which tore to a new all-time high after none other than President Trump himself name-dropped Hyperliquid from the podium in the White House during the crypto summit. It has been a crazy roller coaster of a few days and a couple of weeks indeed, but it might not actually be all roses and daisies from here on out. So we are going to be joined by one of the sharpest minds in DeFi shortly to try and make sense of what is happening, what is ahead, and indeed if some of these catalysts that we've been talking about for quite some time on Solana Floor are going to impact crypto positively, negatively, what's going to happen around the midterms, what's going to happen with clarity, are we going to be getting a better sense of if the midterms are going to be a big issue for crypto or not? All of these are questions that are looming. We haven't quite got the answers to them yet, and neither does Kalshi, neither does Polymarket. So even prediction markets are a little bit stumped at the moment as to where we go from here. but in the immediate future, things are looking good. Now, it is important to remind you all that when things feel like they've completely flipped and prices feel like they're about to go parabolic, when the greed levels start rising, that is precisely when we need a risk manager in the room, which is why this conversation is taking place today with none other than the absolute pioneer in DeFi, Solstice co-founder and CEO, Ben Nadareski. Now, a bit of background on Ben. Before Solstice, Ben was actually running global crypto derivatives trading at Galaxy Digital. Definitely a big name in the space. We've spoken to people like Michael Marcantonio in the past, and they are big believers in DeFi. He also led mergers and acquisitions at Six Digital Exchange. He worked on central bank blockchain adoption at R3. So genuine TradFi operator here coming to join us today. Very interesting background, and he joined crypto in the early days of this industry. With one sole mission, I think, to fix the plumbing and definitely tackle some of the biggest DeFi issues that we face today. But I think the real curveball from doing a little bit of digging on Ben's background was that he actually has a physics background. So a massive range of experience and expertise joining us today. And on Solstice, for anyone who hasn't actually heard of Solstice, Solstice is the largest Solana-born and Solana-native stablecoin protocol aiming to democratize institutional grade yield. Now, it's built around USX, which is a stablecoin, and they have a delta neutral yield token called EUSX. You can go and check that out today. So what we're talking about here is institutional grade yield for anyone from retail to builders and businesses all the way to institutions without necessarily needing to bet the house, which again is the premise of our conversation today. And the delta neutral part of that refers, of course, to the fact that Solstice can offer what it does, one-click yield, regardless of whether markets are going up or markets are going down, which makes things very, very interesting for people that don't want to actively manage their positions day in and day out. Can be tiring. And as we often say, crypto ages you faster than possibly any other industry. Now, that is why it is my pleasure to bring on our first guest of the Big Picture Season 2, Ben Nadareski. Welcome to the show, sir. How are you today?
Very, very good. Thank you so much for the kind introduction, and it's a pleasure to be here today.
Great to have you on. Thank you for making time. Now, I hear you're a Formula One fan.
Yes.
And you've not quite got the Formula One hat on today, but I know you guys sponsored some stuff in the past. I think
here. I got it right here for you.
All right.
The Formula One half with Ollie Behrman.
Oh, excellent.
There we go. We sponsor at the DSX level. We sponsor Ollie Behrman as a driver, which we're very, very proud of. Ollie Behrman is one of those young up-and-coming drivers on the F1 side, but not Solstice, but DSX, our
which is
investor, and yes, our investor, and we're very close. It's run by Tim Grant and Stuart Connolly, great guys, and we've had the pleasure of sponsoring Ollie for the last couple of years here.
Very nice. Now, as it does every year, I think the crypto industry's sort of sharpest minds are going to be congregating in Singapore once again. I suspect you'll be there. Is it early October? I think the 10th is the Singapore Grand Prix. Are you going to be there?
Yes, exactly. And it's going to be exciting to watch Ollie and its involvement. He's been an incredible driver, super young in his career, so I'm always interested in watching the F1.
Very exciting indeed. I love seeing crypto names sponsoring huge events. I mean, Kalshi isn't exactly a crypto native company the way Solstice is Solana native, but seeing them and their banners all over the World Cup definitely made me feel like as an industry, we are moving in the right direction, getting the right eyeballs on in the right places. Now, Ben, I can't wait to hear about how you and Solstice are thinking about, on-chain yield, about risk to reward, the on-chain economy in general. But the show, as you know, is called The Big Picture for a reason. So I want to start with some hot takes, some unfiltered takes, if possible, on the market, and then we'll sort of dig deeper and deeper. We mentioned in the price action in the intro that there were multiple catalysts. So we saw Trump's crypto summit, Besant's buybacks. We know the debasement trade is back on the table. There was about $3 billion in liquidations that we saw. All of these are contributing to the price action that we're seeing right now. But now that Bitcoin's at 80,000, Solana's $105, people are wondering if the worst is actually over. So what is your big picture take as of today?
Look, we are hitting the time frame of the September to December run, which is always one of the most exciting time frames for the markets at any cycle, which we're very excited to see. Second is we are seeing a lot of institutional inflows again, which is always very, very healthy. But third off, I think is the main point here. A lot of the DeFi names in the industry are now they've been around in the industry long enough where they have a name for themselves and the trusted brand is actually there. And so a lot of the institutional allocators, a lot of the bigger wallets in the space, they've been watching these names. Yes, there's a lot of some early movers, some innovators in the space from the investor point of view, which come in early, right when protocols launch because of trusted names, networks, whatever it might be. but they're actually starting to see these protocols stick around for a little while, and they're saying, hey, this has been around, they've been offering great services, and now is going to be the time that we feel as if the trust layer on the DeFi side is there, and we're going to start putting capital in at a serious level. And so the bounce back has been great for that, and I think that that's going to start to build a lot of that institutional trust into getting that capital over the line into a lot of the DeFi protocols. There's an incredible amount of yield opportunities, an incredible amount of products in the RWA space, in a lot of the DeFi yield and the tokenized yield space like we offer at Solstice. And we're very happy to offer that to a wide range of investors, both on the institutional and retail side.
Yeah. I think yield is really one of those things that I want to pick your brain about today. But I hope you don't mind me being really rude right off the bat. First few minutes of our first ever conversation and putting you sort of on the spot, asking you a yes/no question here. But I'm going to do it anyway, Ben. Apologies in advance. Is the crypto winter over? Yes or no?
Yes.
Yes.
Listen, we need to be more positive. If you want a hot take on the industry, we need to be much more positive from ourselves. I say this often. I think one of the major detriments to the industry is kind of the hyper transparency that we maintain because of the nature of the protocols, because of the nature of the technology stack itself. We are constantly optimizing, and sometimes we over optimize. And what that means is when we're in a bit of a down market, we see criticisms and constant and analytics into our industry so far over the edge that we're not as excited from a public point of view. You scroll on X when markets are down a little bit, some of the loudest voices in the industry against crypto are crypto itself. And that's because we're in this constant optimization mode. So I'll take a stab at helping that effort to make sure that we are being positive nonstop about what's moving forward. And again, I think it's not from an angle of negativity or anything. It's really from a perspective of we're built on hyper transparent technology. Our expectation is better than TradFi. Our expectation is to redo financial markets in a much more positive way. So we're constantly in that optimization framework. So sometimes we need some general positivity on all these fronts. So yes, we are over with the crypto winter.
Yeah, I think in the past few cycles, it would have been fair to say so much tribalism that we're sort of crabs trying to get out of the same bucket, keep pulling each other down. But yeah, happy to report that seems to be somewhat over. Now you mentioned yield there and optimizing things, and I really want to dig into that. But just before we get into how Solstice is tackling some of these DeFi issues specifically, I want to ask about yield, which keeps obviously so many of us, myself included, all these DeFi participants here. So let's be blunt. Ben, what is the current yield offering for retail today?
Absolutely. So the way that Solstice has approached it is an exciting, from an objective point of view, is this. It's kind of in a three-stage process. The first stage of this massive kind of, I'll call it next wave of DeFi markets has been, the first wave was tokenization of money with stablecoins, which was a killer app, wide distribution, integration into a lot of payment processors, integration into a lot of day-to-day use cases. It's been great. Then we moved into the tokenization of assets, which is really about bringing assets that are traditionally available on TradFi markets on-chain, put very simply. But that is only part of the picture because you don't quite get to the optimization of what makes it valuable yet once it's on blockchain. You get to that third stage, which is tokenized yield, and that's where all of it comes together. The payment rails being and the settlement rails being in stablecoins, the assets that are traded on RWAs, and the tokenized yield product packaged up into a token. And that's exactly what we do at Solstice. So one of the most very profitable trade over the last 7 years plus, and something that has been a fair bet, has been the delta neutral basis trade and been a delta neutral strategy. That's exactly what we've tokenized at Solstice to offer a modular strategy, I'll call it, which allows for you to capture the yield of the basis trade, effectively trading the difference between spot and perpetual futures in the market, and that natural arbitrage that occurs. We're able to offer that without taking a directional bet on the market. That into, when the basis trade is low, automatically swapping into treasuries as a floor rate of 3 to 4%. That modeling of that old yield package is available at Solstice in one token. So if you're a holder of a large amount of stablecoin, you're sitting around on it, or a small amount, doesn't matter of the size, you can auto swap directly into EUSX to get access and exposure to a delta neutral strategy and delta neutral yields. And that is an amazing turn of where we've seen kind of the evolution of this industry, where rather than just say, I'm going to swap into S&Ps or stocks on chain and everything that we're seeing, which is great movements, you're now seeing a much more complex item, which is tokenized yield strategies being offered in one-click swap availability. And that's exactly what we do at Solstice. And so EUSX does
your one-click yield pitch essentially is you can just swap it natively inside your wallet, regardless of where you are, where you're keeping your stable coins, and you get access to this delta neutral strategy.
Exactly. And it's a wide range of yield opportunities in the space. There aren't just things like USX. Even at Solstice, we offer additional products like Stretch USX, which is giving access to Bitcoin yields. I'm happy to talk about in detail with multiple risk tranching. Staking yields are starting to pick back up with the upturn of the markets as well. And you're seeing a lot of these type of tokenized yield offerings now enter the market, which is really healthy because of the fact that what we want is users that are sitting on large amounts of stable or institutional allocators that have come into the space to have a wider range of yield availability. And the wider range, the more active and more liquid these markets are going to continue to be.
Yeah, let me take the other side of this now. As I mentioned, we love on-chain yield, we love optimizing these things, but without sugarcoating it, we have been burned in the past, right? So I'm going to ask you here, in as blunt a way as you can, lay out the indictment for me. Let's say a depositor takes smart contract risk, they take exploit risk, they're dealing with Oracle risks. You got DPEG risks. We saw this happening with 1010, right, last October. There's AI risk. You've got I don't know, tail quantum risk now. Is like, is it going to be existential for crypto? All these risks piling on, and the average hater of DeFi, let's say, is going to turn around and say, okay, I'm taking on massive amounts of risk, potentially 100% risk to my capital, and I'm going to get 1 to 5 points over a traditional savings account, right? And to a crypto native, maybe it's like, look, okay, it's boring, it's a bank account, it's run by boomers, we don't really like banks, but then I kind of don't want to lose my money. So for Solana natives, for crypto natives, it seems like a bit of a risky time. For the haters of crypto and DeFi, it's definitely, it's given them plenty of ammunition. So how do we defend that trade for yield on chain in 2026 and definitely going into next year? And I guess, why would anyone rational take that trade?
I'm going to try to rapid fire the risk questions out. So number one, smart contract risk at a high level from the technology. From a Solana basis, we're built fully on Solana. We are committed to Solana and Solana's ecosystem. You can see public audits dating back from the launch of Solana down to how SPL contracts work, which is what we're built upon. The smart contract risk, I think, is well managed on the Solana side. That is not something that we've seen direct issues on in any major capacity over the last several years. Number two is that when you look at the depository assets, they are fully on-chain and transparent through third-party attestations, including players like Accountable, who directly took a view into where these deposited assets are, proving that they're there, proving that they're available, and proving that they're not doing anything fishy with them in the background. So we have third-party attestations and full transparency over the accountability of where those assets are sitting. Number three, you mentioned quantum. I always say this, if quantum is to break the blockchain, we have a hell of a lot more problems than that in the industry. What I mean by that is all of your bank accounts immediately broken, all of your passwords immediately broken, your home security systems immediately broken. It is much more of a systemic. It's like people always say, what are we going to do if we lose electricity? Well, it's a bit of Armageddon. So I think there's a wider range of problems at the same time. So I would say the quantum risk is not near the commercial applications yet for us to be worried about that. And number two is that there's a much wider basket that needs to be addressed. And also post-quantum encryption is something that's being implemented into a lot of different protocols and something that we are actively exploring at Solstice as well. I think, let me see what else to address. On the yield side, it's a very simple formula for investment allocators that they look at our algorithmic protocol on. And what I say algorithmic is because of the fact that we have an automated feature. If the basis trade is low, it auto swaps into treasuries. So the floor rate is 3 to 4%. How do we prove that? The strategy that we've been implementing is not something that we launched when Solstice went live. This was something that's been live for 4 years prior to Solstice going live with 100% month over month positive returns. And so we can show that over the last 5.5 years, this strategy has produced 100% positive returns month over month through every single cycle that we've seen in those periods. And why? It's because of how it's designed. And you can look at the direct protocol to effectively prove that. So you have this higher level of scrutiny that should be applied by both institutional and retail investors to everything that we do in the DeFi industry. As I always say, expect more out of DeFi because DeFi can deliver more.
Well, I certainly hope so. And, a lot of the people that I work with, I hope in that way as well. But we've battled with so many reputational issues over the last decade or so, let's say. And it's certainly been getting worse with, state-sponsored hacks and all these external threats. So I'm happy to hear from you directly that many of these things that give people a lot of anxiety are being worked on. But let's talk about communicating some of that yield to people in that case. DeFi, generally not Solstice specific here, cites 12 to 21%. Historically, that's been sort of a sweet spot of how to attract large amounts of capital on chain. Now, I know from listening to your presentations specifically in the past that you guys work with sort of a 5-layered yield strategy, right? It goes from that base layer that you mentioned all the way to an institutional strategy layer, which is super cool. And I urge people to go and check that out as well if they have any questions about yield. But we've seen massive shifts in DeFi since specifically the October 10 crash, massive deleveraging. And it seems also that we're sort of nearing similar open interest levels again. So that's another source of anxiety people have at the moment. And one of the questions I've seen people throwing out without an answer to is this sort of period that we had of high yield on chain, high DeFi yield without taking on 100% risk to their capital, is that over? Or can we actually get to that point again where, retail investors can actually get institutional level yield without risking all of their capital, all their savings? Because it has been a stressful period.
Absolutely. So look, the type of yield matters and how that yield is managed matters. The world in which we promise yield in the DeFi industry that is not scalable or transparent is over. That is for sure. And what I mean by that primarily is that a lot of those times those yields are artificially boosted. If there was a way where you could put in billions of dollars into a strategy and get 15+% yield consistently with minimized risk, that doesn't exist anywhere in any financial market. That's a raw fact. And that's always the holy grail and what everybody wants. But the truth of the matter is that these things have limitations, scale limitations, risk limitations baked into them. So what we're very proud about is the fact that, for example, our EUSX product is one of those things that we can scale to billions. We can put into large scale capital deployment without those risk matters, and we're not artificially pumping the yield in any capacity with tokens. Now, there are other opportunities that are much more exciting, like Stretch USX. With a dual tranche risk system, we're targeting on the senior tranche level around 8-9% directly from the Stretch product itself, which filters directly into the senior tranche. And then the junior tranche risk as well, which is targeting upwards of 20+% risk. But that is the 20+% yield on that front does come with additional risk and does come with a different structuring. We've also put cap limitations on each of the different tranches. So as we scale, those tranches come down. Those tranches are modular to adjust to the risk models. And those are the type of products that we're seeing in the market that are succeeding because of the fact that institutional investors understand we're not promising anything that doesn't exist. And I think it was a bad vicious cycle, I'll call it, because what happened was we saw DeFi promise a lot of high yields in the early days, and a lot of protocols kind of ski a little bit, lean above a little bit far above their skis. And then the investor circles started to hit these high watermarks of what's going to be expected. And so you naturally would say, oh, okay, a 5 to 10% yield is not at my watermark yet. But if you're really looking to deploy serious capital, and if you want to be honest about the risk structures of that, those are the best opportunities that we're seeing in the market right now that are scalable and risk adjusted. And so that's exactly what we wanted to offer at Solstice, is because if you look at what effectively a perfect portfolio would look like, you have a certain amount liquid in a stable coin like USX, you have a certain amount earning at a treasury delta neutral risk managed yield layer, which is going to be the majority of your portfolio. And then you have the more higher risk yield adjusted layers for the upwards of 10-15%, which is where we have the junior tranche, for example, on the Stretch layer. So offering all three of those at once allows for an investor to have that flexibility and choice of option. And we should expect a lot of other protocols in the space to also emulate that in being honest about the scalability factor to each of these yield products.
I really want to ask you about that as well, because you mentioned rightly so that in the past we've had these on-chain experiments, should we say, with massive amounts of yield, and struggling to think of a single time where it didn't blow up in our faces. So what we're doing now is we're learning, it seems to me, from the mistakes of TradFi and the previous mistakes of DeFi, and we're sort of marrying the two as far as, risk management, which people don't like to talk about in crypto. Just aim for the moon and hope for the best, but it hasn't really worked out for us in the past. So is it fair to say then that the only way DeFi is going to sustainably offer safer yields on chain, safer and at the same time slightly higher than traditional instruments perhaps, is to learn from the mistakes of TradFi, is to learn from the previous mistakes of DeFi and sort of emulate the success without aiming for the moon every time we offer a yield product? Is that fair to say? As boring as it may sound.
I think it is fair to say, and I think more than anything, you have to be just very honest with yourself about what type of yield it is. There's a lot of incredible opportunities in the crypto space on all sides of the risk spectrum. Let's make that very clear. Number one, expect more out of DeFi because DeFi can deliver more. I'll say that over and over again. But with that being said, things like meme coins or quick, happy, like a lot of the more exciting craziness that happens in this industry, you have to be very clear about what type of investment profile that looks like. And so as long as we're honest about that side of things, and then we're also honest about players like Solstice, et cetera, out in the market that are very risk managed, and they're not going to be as sexy, they're not going to be as exciting, eyeball grabbing, but they're going to be sustainable. We have to remind ourselves that even those lower end yield products, those are things that come with a number of different benefits outside of just that core yield number. Complete self-sovereignty of it, complete self-custody of it, of those assets. For example, when you swap into EUSX, you own that EUSX. And first off, and on top of that, you can also go do things with that EUSX. That's not the end of the story. You can go do things on Camino, on Loopscale, on Exponent, on Jupiter, on more of these EUSX products. You can go optimize your capital additionally. Those are things you cannot do in the traditional space, and you're able to gain these benefits because of the fact that they're in DeFi and because of the fact they're on blockchain. So it's a fair balance, but as long as you're being hyper transparent as a team, as a protocol, and as a company to your investors of what type of risk profile, yield profile, and capital optimization profile you're able to receive, you have to be sure that you're being hyper transparent about that. And I think that's the major shift. Rather than is yield profiles coming down as an industry, et cetera, crypto's got everything. It's got all ends of the spectrum. Be hyper transparent about it so that way it's very clear for the investors. So that way you're not selling them on one thing and actually giving them another. And that's something we've tried to draw the very hard line for with our investor base.
Yeah, and I think we're definitely going to see more of that type of communication from the more mature industry players and Solana players. I think as the industry as a whole continues to mature and we, bring on more mature investors. I've said the word mature quite a few times there. So going back to something that perhaps is more fun at its core, in its nature, I'm going to pop the question. Ben, one question to rule them all. Why Solana?
Why Solana is a very easy question to answer for me. There's three kind of buckets to this. Number one is the faster, better, cheaper option. That's the easy answer. That's the one that I think is the technology speaks for itself in a lot of ways. Number two is the composability factor. Once you enter into the Solana ecosystem, for example, if you enter through Solstice, you now enter into all these different players, 50 plus partners and ecosystem players immediately. It is not a zero-sum game, and you're constantly seeing overlap, composability, and transfer of assets because of a seamless layer all at once. That is what we call internet capital markets for a reason, is you're able to enter this ecosystem and stay in that ecosystem without having to worry about bridges, L2s, et cetera, that you might see on other chains. That is a huge factor of that. And number three is the growth. When we started Solstice, the stablecoin volumes in general, or the stablecoin liquidity level was around $2 billion, and now we're over $16 billion in stablecoin volumes in Solana for a reason. There's a lot of inflows activity happening, and that happened very clearly, and I want to say this very, very explicitly, through a very large bear market. We saw this type of growth. And why? It's because the less sexy, exciting, large-scale institutional capital and players in the market offering these yield solutions entered in despite markets being down. That's a testimony in itself that very few chains can say. And so we're seeing kind of the full package of availability of a faster, better, cheaper chain, high growth potential with a lot of the growing applications and large-scale players all entering in at the same time. And more than anything, I'll stress that second point, is this composability. It's not zero-sum. When we work with other partners and ecosystem players, I'll highlight some of our key partners like Camino, Exponent, Loopscale, Jupiter. These guys are some of the best players that I've ever worked with. We work with them hands-on in joint proposals out into the market, and it's a fully cohesive ecosystem. We're doing this together, hand in hand. We're not doing this against each other.
Yeah, that's definitely a recurring theme from talking to many Solana founders, is that, unlike other ecosystems that some have worked in the past, you do have this sort of sense of unity and, I guess, a shared vision, which is always nice to hear. Which of those areas of growth, you mentioned quite a few of them there, different leaders within the Solana ecosystem as well, which excites you the most, not as a builder, not as a founder, but someone who actually uses DeFi day to day? There's so many different applications, novel uses. You've got on-chain gacha, which recently exploded. If you're into collectibles and Pokemon and all that kind of stuff, it's very exciting for people. Prediction markets, obviously being straight in people's wallets, is exciting to others, but stocks on chain, another angle. Which of those excites you the most as a DeFi user?
I think there's two aspects of it that excite me the most. Number one is anything privacy layer and privacy built. There's a lot of privacy applications coming out into the market, which I think is the next stage that we really need to get back to as an industry. Where we started was a very much cypherpunk against the current grain, and it really turned into this great explosion of institutional activity. But we need to make sure as an industry that we're not just turning into glorified back office for TradFi. That's a very real concern that I have. This is something that I'm always keeping my eye out, and that's why we maintain permissionless principles at Solstice entirely. We cannot turn into these players that are simply just building what I'm calling glorified back office for the traditional market players. And that is something that we have to be conscious and aware of 24/7, because the big eyeballs and the big wallets are always very attractive, but we have to make sure that the tech that we're building is with a mission in mind, and that is to change the financial markets into the way that we see as the best route forward. And there's a lot of brilliant minds in this crypto ecosystem that need to be pushing for that narrative at the same time. And the second one is effectively anything that gets you other protocols similar to Solstice that are offering permissionless based yield. In doing so, you're able to hold large-scale capital in stablecoins, and you're able to auto swap into those yield opportunities without having to go through additional security risks, additional custody risks, and additional I'll call it downsides that you would normally have to give up in order to retain that yield. So those are the two angles that I'm most excited about. There's an incredible amount of yield opportunities to go explore in the space. I always say this: what we need from Solana is a brochure, a public brochure of how to enter. Welcome to Solana, the all-inclusive resort, right? And this is exactly what you get. This is exactly where you can go, and this is exactly what's offered. It would be really nice for the whole ecosystem to be able to share that brochure of all the different players and ecosystems at once. And there's a lot of versions of that in different ways, but I think we need a professional one, which I think we'll have to talk to some people about.
Interesting. Well, I like that framing as well of sort of an all-inclusive resort. And you said, one-click yield. I'm liking these sound bites. These are good. It's making me think, why didn't I think of this earlier? But is that trademarked yet? One-click yield?
No, it's all one-click yield. We've definitely used. It's not trademarked. Feel free to use it. But the brochure, all-inclusive resort, we'll definitely share that. Everyone should be using that, because again, this is not a Solstice concept. Look, if Solana wins, we win. Vice versa. It's the whole ecosystem together as one effort. So yeah, absolutely.
Agreed. Now, probably a good time to start talking about STRC USX a little bit more detail as well. People are saying, is this a real fix, though? Going back to some of those, let's say, risk myths that we addressed, is it not better audits and, boring TradFi instruments like insurance layers and structured tranching, which you sort of discussed there as well a little bit? Are these not the things that we need to fix where we are as an industry? Are some of the sort of concerns that are being raised? But yeah, talk to me about STRC USX as a model for addressing some of these risks that we're dealing with, and I guess some of the risks that people don't want to underwrite at the moment as well.
Absolutely. So Stretch USX is, I think, one of the best ways to get Bitcoin exposure in the Solana ecosystem. And it's one of, I would call it very proudly, one of the most advanced DeFi products that we've ever seen come out to market for a number of reasons. Number one, it maintains all the permissionless principles and everything that we've discussed in the past around the core structuring of the product and offering for achieving yield in the first place. Number two, for institutional allocators, the senior tranche will be very attractive because of the fact that it's backed directly by strategy, and the yields from those Bitcoin holdings are consistently backing those. Even when Stretch dropped from par from 100 down to 70 plus and then back up, in that period, it was still paying out positive yields. It was still a product that was offering positive returns, and this was something that was a great offering. Now, what's exciting about the Stretch USX side is that we've bifurcated into two different risk tranches with full in-house solutions around a senior and junior risk tranche. In order to do that, what we do is we cut back the senior tranche slightly and offer additional boosted yields on the junior tranche side with a higher risk. So if there is major volatility, junior risk will absorb that first, but it does also protect the senior level even more. And as a result, the junior tranche is able to participate in things like 20+% yields right now in the offering, which is something that very few scalable, risk-managed, and hyper-transparent permissionless DeFi products can offer. And we'll say that very, very proudly in the sense that this is a product that DeFi users wanted to see, and this is a DeFi product that we're offering at Solstice. We're very proud of the efforts that MicroStrategy, Michael Saylor, and these guys have been put out to the market for a reason. It's because they have a relentless bet on Bitcoin, and that those yields will continuously to pay out to its users. And the better structured products, there's a lot of tokenized versions of Stretch that just simply give you the exposure to Stretch. But now we're taking that one step further. Expect more out of DeFi because DeFi can deliver. That is the exact example of this right now. Stretch as a product is great, but let's expect more out of it. Okay, great. You can separate now the risk tranche into the different yield profiles that suits your portfolio. So I highly encourage users to go check out Stretch USX and the 2 different risk tranchings out there into the market. There's a lot of great availability, and there's going to be capped kind of introductory levels as we just launched the product and it's very new. We're going to be putting it into certain risk caps, so caps of capital, as we scale Stretch USX into the market for the coming months.
Is there a sort of a one-click way of deploying into these different tranches as well for people, just to really simplify it? How would they go about doing that?
You go to solstice.finance, you click on Launch DApp, and you swap your stables into the Stretch USX.
Pretty straightforward. Okay, let's talk about 1010, because it was, for many people, a bit of a catastrophe. I think talking to people in November, even into December, there was this sense that, okay, we're going to breakpoint in Abu Dhabi, the capital of capital, everything's going to be great. $1 trillion asset managers are going to be there. But are we waiting for some bodies to sort of wash to the surface? People were very concerned, and rightly so. I think now is a good time to sort of resurface that, because people are saying, hey, look, open interest levels are nearing these levels again. We know for a fact also that Michael Saylor, we're talking about strategy and Stretch there, his position was massively underwater and is now massively not underwater thanks to a great 2 weeks of price action. But the risk, and I apologize for continuing to come back to the risk, but DeFi risk is, I think, the theme of the week in that sense. Are we not facing a similar set of risks now, leading into that similar level of open interest as October last year? Are we not building similar fragilities, if you will, that caused 1010? Or can you confidently say, no, look, we have, we've dealt with some of those issues. We're heading into a healthier sort of market structure for late 2026 and early 27?
It comes down to one major piece, and that's education. And what I mean by education in this case, which is what caused 1010, in my opinion, in a lot of large ways, is things like auto deleveraging, ADL exposure into a lot of DEXs, to say it explicitly, compared to SEX exposure. And what I mean by that is this. When you go into leverage trades, when you go into trades in the market for things even like the basis on plays like Hyperliquid and others, you're seeing a dynamic with auto deleveraging. There are not these, if for example, if there's major market swings, you get auto deleverage, you get auto liquidated from that position. Now, in decentralized protocols and in these very automated protocols, the education of what ADL exposure means, yes, when everything is going up and there's a current consistency in the market, you don't think about the fine print of how these exchanges truly work. And so in order to ensure that you're being smart with money management at a large scale, you have to ensure that in those type of risk scenarios, you know exactly what's going to happen. Now, you do not see, there's a lot of SEX exchanges that also implement ADLs, et cetera. But the bottom line is you have circuit breakers, you have warnings, you have a lot of these type of institutional grade barriers. And so when you're trusting multiple other counterparties between the assets and the exchange venue and what you trade on and everything in there to leverage up on large scale positions, that story, as time and time again is shown, both on the crypto side and the TradFi side, comes to an end at some point. And in the crypto world, that comes very quickly because of the fact that there's auto liquidations on that front. So what I would recommend is, in order to avoid that as an industry, what we have to do is make sure that the education phase for a lot of these large scale institutional investors and retail investors that are coming in size is to be aware of the fine print next time. And what we mean by that is there's ways to mitigate ADL exposure as well in your portfolio in a lot of smart ways. We have to make sure that all those things are aware. This was the first time that it kind of happened all at once. And that's why we saw this massive, oh no, the world's ending type of moment. And we always like to go to the, I always think of that meme where it's like, it's so over, we're so back, and it just keeps going in a circle, and it's just one or the other, just 0 to 1. It's got to get away from that kind of volatility from 0 to 1, 0 to 1, 0 to 1. We are going to be floating somewhere in the middle. And it's going to come down to everybody on the institutional side really reading the fine print of crypto, because you can do a lot more stuff with DEXs than you can with SEXs. And there's a great value proposition there, but mitigate your risk accordingly. And it's that simple. We can't be pitching things that we cannot deliver. And what that means is the show goes on forever, and there's never going to be a downside, and it's never going to drop 15%. It's never going to drop whatever it might be. Those things, you can never promise that. You can never expect that. And so you have to be flexible to all these different market moves.
Certainly, yeah. I think do your own research is something we say all the time, and then probably don't do it. So
it is so true. I cannot stress that enough how true that point is. You
Yeah.
do your own research, and again, expect more out of DeFi because DeFi can deliver more, and there's an incredible amount of great players in the space, but it's not everybody. The flexibility and freedom of DeFi is beautiful because anybody can come out and build a protocol and go launch it. That doesn't mean that every single thing is perfect to invest in. You have to go through, when we did that rapid fire risk question analysis, another basic question that you can always ask is there time locked multi-sigs with more than 3 out of 5 SIGs for some of the major capital movements?
That is a great point.
Basic security protocols, like, do these protocols that you're investing in have these basic implementations? If they do, they're a step above TradFi. If they don't, they're a step below TradFi. And TradFi is kind of we'll call it the middle wayfair point in the market of what good risk and bad risk looks like. We'll call that there because it's stable and it has been something for hundreds of years now. But the bottom line is DeFi can be on both ends of that spectrum. There's a lot of great players on the upper echelon of that spectrum. You just have to do your own research.
Yeah, and for our listeners who maybe haven't seen these on the timeline, after the horrendous hacks of Q1, Solana specific here, a bunch of vibe-coded sort of checks, if you will, were introduced as well. Just making sure that they hit that 3 to 5 multi-sig threshold and so on and so forth. So you can find those, I'm sure, very easily by searching on crypto Twitter. But I want to zoom out for a second. I want to talk about macro and clarity, another set of risks, if you will, sort of external pressures more. It seems to some extent that we're dealing with them. Let's talk about clarity specifically here. I must admit, Ben, I was a bit humbled by the political climate in the US. I was very opinionated about what clarity would do. I had a rather sizable bet, let's say, on it passing in August. Again, I was humbled. I was very wrong because politics got in the way, which is fine. Because again, it seems that things are moving in the right direction. We had the White House Crypto Summit recently. Prices have reacted very positively to that. But as someone who's building, I guess, rather than just investing in financial applications on Solana, what does clarity actually change if it happens in September? I think it's 15th is the cloture vote. What happens if it doesn't? Is it we just continue like nothing ever happened? Or is it, no, this is actually a sort of a bit of a crisis that we're heading into as far as you see it?
The constant regulatory environment, and there's always a lot of regulatory questions that always come up in our world as well. We have to continuously put on pressure about adoption so that way it becomes a real concern. For example, stablecoins, we had such a widespread, it was a killer app in so many different ways that it put such a mounting pressure on traditional financial institutions to change models and to accept this as currency because of the fact that the whole world was so excited in using this. We need to get to that point with RWA and now tokenized yield exposure and amount that pressure so much that regulators don't have another choice but to say, we can't go against what the people are using, and the basic utility of doing this at self-sovereign, low fees, et cetera, is going to outweigh and outpace the current financial market. It's all about what effectively the banks and the current guard have control over. And they've accepted a bit of loss on the payment processing and the international payment transfers and that side on the stablecoin side. And now I think the next step is them to accept the loss on the RWA and the tokenized yield play.
Right, but just to take the other side of that, I'm not sure that they will. So you mentioned rightly that we have to put pressure on the regulators, and as an industry, I think we're doing what we can. You've got Brian Armstrong out there, for better or worse, fighting the good fight. But then the other side of that is the big banks in the US can and will mount their own forms of pressure as well. You had Jamie Dimon come out not too long ago and say, Brian Armstrong's full of shit on live TV, excuse my French. But, if he's saying that, then he's also willing and able to put his money where his mouth is and fight against the crypto industry for things like stablecoin yield. Because guess what? If the top 10 banks in the US make north of $100 billion a year in profit, then they're probably going to fight to protect that bottom line, would be the counter of the argument. So how do you square that circle of, okay, we're moving in the right direction, financial innovation, bring more money on chain, but we're fighting against this sort of Goliath, if you will, of big banks in the US?
Yeah, it's I love when people bring up Jamie Dimon's comments, because again, it's the perfect example of somebody in the market who will say what is needed to say in order for them to protect themselves and get ready for that stage. And then once that's ready, then everything's fine, right? He said Bitcoin was a piece of shit for the longest amount of years. et cetera, out in the market. And then finally, they got to a point where they started doing work into that industry. And he said, oh, yeah, well, actually, maybe it is something. It's like, well, great. It's because you finally positioned yourself accordingly. Yeah. It's an absolute joke. And I'm very sick of the way that the traditional institutions have been handling this. The bottom line is this: it's all about protection of their revenue lines, unfortunately. And yes, that is backwards in the US, but we keep the mounting pressure on and we keep education layers on. There's a lot of great efforts of councils, of lobbyist groups, of whatnot in the US that work on effectively education phase around what this blockchain, there's ways to implement that blockchain under certain standards, protocols, and doing that. But what that takes is a massive amount of education for regulators, policymakers, and financial institutions in the US to understand how to do it safely. And there's not enough people on the education side, unfortunately, because of the fact that it's not as paid well, I'll call it as it is. You need to be in a position to go out there, lobby, and say, this is exactly how this works. Once they realize it, the story is very clear cut. I have full confidence in that. When you go to them and show them how this would work in full scale implementation with full government regulations, you can get over that point if they're educated and if they can get to that education point. But breaking through that barrier of somebody who's like, I don't even know how Bitcoin works, and you're trying to convince them on a tri-party custody account with multi-chain integrations, etc., it's going to be a large step of them to say, it's all just too foreign to me. And that's what happens time and time again at these policy layers. So we need to continue the education front more than anything. That is what we need to do. And in the meantime, the rest of the industry, the innovators, the DeFi participants, we need to mount the pressure, keep liquidity flowing, keep application usage growing, and show that there's real use case for this among the global retail participation and constituents. It's a trend that's not going away, and we need to nonstop put pressure on these guys who are much less educated into the world of tech that we are.
Yeah, let's make it specific then to instruments, products like EUSX. If Congress does turn around and say, you know what, too much political pressure, we really want to change things heading into November midterms, and then you get this restriction of yield-bearing stablecoins, what happens to EUSX and some of the other similar products out there?
I'll be totally blunt. As of right now, we are not a US-based business in any capacity. And I highlight that to a lot of institutional investors and a lot of people that I know in government, a lot of people that I know in the regulatory environment as well. It's an amazing product, and we cannot directly offer it and market it in the US. This is something that is a huge shame.
Seems like a shame, yeah.
Yeah, I'm a US citizen. I was born in New York. I don't live in New York anymore, but the bottom line is that in this dynamic, we have to be really realistic about this. We have an incredibly innovative product, an incredible growth product for DeFi. We cannot offer it in the US, and the US is choked from that business opportunity entirely. And I'm not just talking about Solstice. We're not that massive player where just us alone going into the US would make life-changing differences for the financial markets. I'm not going to be overstating our presence, but the dynamic in which EUSX currently exists, there's lots of other players that also will benefit from this, even cross-chain, that can really, as a whole, change the industry. And that is what's blocked from the US. That's what's completely blocked from the US. And it's one of the few markets. There's probably, I think in total, there's probably 3 or 4 markets globally that have impact that we're not directly marketing into. And that's places like mainland China, North Korea, Russia, Iran, and the US.
It's crazy to hear those names even in the same category.
It's in the same exact bucket when it comes to this type of control and oversight. Yeah. I'm really sad to see this in the US in a lot of ways, but I also think it's a huge growth opportunity because we know that things do change fast in the US. We have to maintain to be positive about it. And again, if we're educating these policymakers and we're showing that there's benefits to them, and we got to include them in the story as well. What I mean by that is say, if you have investment portfolios, start dabbling in it yourself. All these major regulators and lobbyist groups and all this stuff, they have massive investment portfolios. We have to show them firsthand what that looks like. I would always say, if you want to learn about DeFi, the best way is go trade it.
Use it. Yeah, be a participant. I agree with you. I find this interesting though, and for the record, I completely agree with you. It is a massive shame that we have to list the US along with countries like North Korea and Russia and Iran when it comes to crypto regulation and clarity. But I find this interesting because after the Gensler era, for this, maybe 6 to 12 months, everyone was like, look, we're going to have this massive onshoring or re-onshoring of US built and US incubated crypto businesses. It's all going to be blue skies. We're going to have all the sort of cooperation between builders and regulators that we need. And now it seems that we've hit, once again, a bit of a brick wall. Do you feel that we're sort of on the cusp of another turning point, another inflection point in some sense, given that even Trump is in the White House saying, look, we're going to bring hyperliquid onshore? Or is it really pandering to the masses, these single issue crypto voters in the US, of which I think there's about 50 million, such that, you know, they can cement their position ahead or after the midterms in November? Because as a European, as a Brit, I struggle to sort of, make sense of what's going on really with the political climate in the US sometimes.
I honestly think we just have to take it on the chin and push harder on the next push. It's the rough reality of it. And yes, you can talk about kind of the analysis of politics into this in a lot of different ways, but it really comes down to one answer, and that's increasing pressure in every single capacity, increase education. I can't stress that enough. I've talked a lot about the regulatory. I've sat on some councils and whatnot that have advocated for laws in the US, writing some state laws on crypto and whatnot. And it all comes down to that factor, no matter what. And this is just another scenario. It's not turning the other way. Crypto will continue to go up and to the right as far as adoption, nonstop. Yes, there will be moments of corrections and moments of downfall, moments of whatever, but the bottom line is over the long horizon, talking objectively, crypto is here to stay, and crypto will be continuously adopted no matter what. That is going up and to the right from here on forward. And so it's just a matter of time before the US adopts this regulation. And it all really comes down to the industry. Everybody listening on this call, yourself, us as the industry, we are the industry. We are responsible for bringing these type of lobbyist groups, regulation, education sessions, and amounting pressure of why this matters. It is on us. It's in our hands to educate and to bring this forward. And if we didn't push it hard enough on Clarity Act, we need to do better. So what does that mean? That means Brian Armstrong needs a few more voices next to him with a bit more of a creative story to get this over the line on the next run. We can't be putting all of our eggs in one basket here. We need to be doing this as joined hands industry here.
I like that. I like that approach. Now, to make it a little bit more concrete and to address at the same time one of the comments from our listeners who says, I feel that this might be a bit of a fake out. You mentioned the crypto in terms of adoption is probably going to continue going up and to the right. But what about price? Might be difficult for you to comment directly on price, but gut feeling, not financial advice, of course. Do you feel that this was a bit of a fake out, addressing that comment specifically, or is it blue skies ahead from here?
Yeah, look, the price, and this might be a little bit of a controversial take, but the bottom line is this. The price impact on the industry that we're seeing right now, we've given up a lot of our spot control to institutions.
Yep.
It used to be, without the institutional involvement, the natural growth, development, applications in the market, liquidity, all the exciting innovation used to be priced in very closely. But now that we have these massive traders at BlackRock and others block trading crypto nonstop, at any moment from any political environment, no matter how many exciting developments in crypto that there are, we do not have control over spot anymore. The foundations don't, the individuals don't, the teams don't. As a broader industry, we have given up our spot control to a lot of institutional players. And so as a result, over the last 2 years, we've seen more explosive development and innovation in the DeFi industry than ever before. And it wasn't priced in. And I constantly thought about that. You think, how is that possible? And you look at where a lot of these outflows are happening, and the things that are controlling a lot of these major movements in crypto are these massive size movements. Because if any moment there's any skirmishness around markets or anything, the institutional players that have a small portion in the crypto market, which in our world, the small portion from the institutional TradFi player like BlackRock is a huge volume. That's the first thing to go. That's the first piece to get liquidated. We're a side thought to a lot of the traditional institutions when it comes to an investment portfolio. And so what happens is in these scenarios, the spot control gets lost. And that makes us as DeFi builders in the DeFi industry feel as if, oh, it's a bear market. Things aren't going well in the industry. Meanwhile, we're seeing explosive innovation on all these fronts. We're seeing massive talent crossover. We're seeing new markets being developed. We're seeing additional RWAs being put on chain. We're seeing all of these different, very exciting, positive growth metrics. And our spot price isn't representing that in a lot of ways. So we're at this point, and that's why we feel like there's a bit of an identity crisis in the industry, is because we've given up that spot control to institutions, and that is not our world, because they're not advocating like we are for the growth and development of this industry. And yes, there's a huge crossover between these institutions and us, and we need to work together with them. But we also need to be very honest over the fact that the spot price does no longer state our success as DeFi in the current state of affairs in the market. And we're in this middle ground, which is why that's the identity crisis piece. We have to get a little bit further, so that way the institutions are fully on board, so that way they adopt with us. As the innovation grows, they grow, and as the innovation goes the other way, We have to be in sync with that. And that's the disparity. That's where the identity crisis, I think, is really coming from in DeFi right now.
Yeah, I honestly think that could be a 60-minute conversation in and of itself, that identity crisis that you're describing right now. And we do often talk about this discrepancy between where we are in terms of fundamentals and price. People are saying maybe there's somewhat of a convergence happening at the moment, but remains to be seen. In the interest of time, I must continue on to my favorite part of these conversations, Ben, which is a rapid fire round. As short of an answer is what I'm going to request from you, as is humanly possible. So it might not be possible, but let's give it a go. Are you ready?
All right, I'm ready.
All right, DeFi in 2027, is it going to be healthier or more fragile than today?
Far healthier.
Far healthier. That's very clear. And yeah, you addressed some of the risk issues that we brought up earlier, so no need to belabor that point too much. But what is a realistic, sustainable on-chain yield for the average retail user 3 years out from now? Is it going to be 3 to 5%? Is it going to be 6 to 8%? Or can we really, hand on our hearts, aim for 12 to 15% without people losing all their life savings?
For investments that are scalable past 100 million, 5 to 10%. For investments that are under 50 million, 10 to 15%. And for solutions that are in the billions, anywhere from 3 to 8%.
Clear. Very clear. This one's a bit spicy. And again, I mentioned earlier that I was humbled. My predictions were completely wrong about the Clarity Act passing. The political landscape humbled me. Is it going to happen in 2026? Yes or no?
No, but in 2027, I expect it to.
Okay, interesting, because Senator Lummis was basically saying if we don't do it this year, it's basically 2030 is going to be the next chance that we have. But you think no, that was just to apply pressure, and there is a realistic probability of getting over the line. Absolutely. In 2027. Okay.
Absolutely.
Interesting. So I will revisit my poly market positions in that case. What's the bigger threat to DeFi products like Solstice in 2027, right? So not so much this year, but after the midterm, specifically January on, I think it's going to be an interesting time. Is it an exploit? Is it going to be regulatory or political risk? What's the biggest risk for DeFi in 2027?
For protocols like Solstice, it is collateral damage from protocols that do not have security buttoned up. And what I mean by that is we saw some really unfortunate things happen across the Solana ecosystem over the last 6 months with some major players. That is not something that's systemic as Solana in any capacity. However, outside players that come in, and if you don't have an educated view, they're going to assume that it is. And so the standard of security needs to be addressed immediately, if not already addressed, by every single major protocol in Solana. We need to have that standard be safe, and we need to be things like 3 out of 5 time lock multisigs. That should already have been a standard that should have already been implemented on every single protocol, those type of basics. In doing so, you are above traditional institutions on security. In not doing so, you are below them. It's very wide swing because of the flexibility that DeFi offers. So the biggest risk is going to be, I think, collateral damage to a lot of protocols that have implemented these security protocols, not just Solstice. Lots of others have implemented these at this high level, but some protocols leave that to the wayside. And that affects all of us when anybody doesn't do it right now. We're viewed as an industry, we're viewed as a family, not as individuals right now.
Sounds reasonable enough, especially after some of those events that you described. But we are not there yet. Pardon me. So systemic risk you mentioned there. Quantum risk is another one of these. Is it going to be life or death type of question? So quantum risk to DeFi in 2027, is it an existential threat? Yes or no?
Quantum risk is categorically an existential threat to everybody, and not in the crypto industry alone. In all of your finance industry and all of your personal data industry, and everything that you ever do with anything technological is a risk with quantum risk. That is categorically the case. However, with that being said, where we are in the current quantum sphere compared to where it needs to be on a commercial application scale to have that risk be implemented, we're years out from that.
That's good to hear. Now, I have a sneaky suspicion that your answer to this next question isn't going to be go ape into some NFTs or meme coins, but I'm going to ask it anyway. What's the single biggest piece of alpha that you can share with us today?
Honestly, the biggest alpha, and I'll advocate for this, is Stretch USX. It's not very, very widespread and well known yet. We've just launched this out into the market, and in my genuine opinion, it is one of the most advanced DeFi products out into the market, offering an incredible yield base right now that is live and easily one-click swapped into on Solstice.finance. There's an incredible amount of opportunity there. Strategy has turned around immensely. This is a great opportunity to get some of the most advanced Bitcoin yield in the Solana ecosystem right now, and it is fully available at Solstice.finance.
Excellent. Ben Nadareski, it has been an incredible conversation. I want to thank you for bringing us a very high signal conversation, actually, in an extremely noisy part of the cycle. There's opinions all over the place. And also thank you for restoring some of my recently shaken trust in DeFi. After the first half of 2026, it was difficult to think about some of these risks, but it's great to hear from people like yourself who are actually building in it. Now, where should people go to check out Solstice, Stretch USX, and some of the other instruments that you have? And also, where can people stay up to date with the announcements, follow along with updates from yourself too?
Absolutely. So you can go to solstice.finance and have automatic asset store DApp for EUSX, USX, SLX, and Stretch USX exposure. It's all available there at solstice.finance. You can follow up on any of the protocols, updates, and news at SolsticeFi on X, and Ben_Solstice on X for my personal, if anybody wants to follow along as well. And we're always willing for feedback, conversation, questions, whatever it might be. So very excited to be a strong Solana advocate here. Thank you so much for the conversation.
Absolutely. Ladies and gentlemen, that was Solstice CEO and co-founder Ben Nadareski. We are going to be back next Thursday, 11 a.m. Eastern. So same time, same place for more crypto alpha and, of course, more macro breakdowns. If you do want to stay updated and ahead of the curve, then you can go and subscribe to Solana Floor. It is free. You'll get loads of deep dives, loads of live streams, and non-stop coverage on X and YouTube. Tomorrow at 11 a.m. Eastern, we have our Solana Weekly News live stream. Joining us is none other than our favorite Bloomberg Intelligence leading analyst, James Seifert. So don't miss that episode. Ben, thank you once again for joining us. Really appreciate it. And to our dear listeners, see you all tomorrow for more of the latest.